The biggest risk in banking right now may be standing still. Welcome to the Commercial Pulse update for March 10th, 2026. The Experian Commercial Pulse report is a bi-weekly report offering a snapshot of the US economy and its impact on small businesses. February unemployment came in at 4.4%, ticking up slightly from 4.3% in January. Average hourly wages rose again to just over $32 per hour, though the pace of wage growth is moderating. At the same time, the US economy lost 92,000 jobs in February, marking the fifth monthly decline in the past 9 months. So while the labor market remains resilient, we're clearly seeing signs of softening. Inflation continues to ease. The January CPI came in at 2.4%, the lowest level since May of 2025, with core inflation also trending downward. However, energy markets are adding renewed pressure. Crude oil recently spiked above $81 per barrel due to geopolitical tensions, pushing fuel prices up 11% month over month. For lenders, this creates an important dynamic, moderating inflation, but potential near-term volatility tied to energy costs. On sentiment and how people are feeling, consumer sentiment edged up to 56.6 in February, its highest level since August of 2025, though still below year-ago levels. Small business optimism dipped slightly to 99.3 in January, reflecting cautious confidence among owners navigating cost pressures and credit conditions. The Experian Small Business Index blends business owner and small business elements to provide an indicator of the financial health among those business owners and their businesses across the US. In January, the index rose 8.5 points to 54.3, and that's up 12.8 points year over year. With 40 to 60 considered a normal range, this places the small business environment firmly in healthy territory as of January. The increase was driven by lower credit utilization and fewer overdue balances, alongside stronger demand for access to new credit. In short, small businesses are borrowing and performance remains stable. There are a few areas to watch though. Later stage delinquencies on commercial trades and early stage delinquencies on consumer trades ticked up slightly, signaling the importance of continued monitoring. Macroeconomic conditions offered support. Inflation eased to 2.4% and the labor market was steady in January. At the same time, personal savings declined again and the PCE price index remained above the Fed's target, suggesting some ongoing household pressure. With 532,000 new business applications filed in January, entrepreneurial activity remains strong, expanding opportunity for lenders. Overall, the index reflects a stable and improving small business credit environment, balanced with a need for disciplined risk management. According to the Federal Reserve Senior Loan Officer Survey, fewer banks are tightening standards compared to prior years, but they're not meaningfully loosening either. In Q1 2026, the net percentage of lenders tightening standards fell to 5.3% for large firms and 8.9% for small firms. Demand for business loans is trending up, creating a balanced environment, stable performance, moderate tightening, and steady borrower appetite. The Federal Reserve held rates steady in January after 3 consecutive quarter-point cuts in late 2025, so all eyes now turn to the March 17th and 18th meeting, particularly with February inflation data being released shortly. This week we take a closer look at consolidation in the banking industry with some very interesting trends. Large mergers created consolidation in the banking industry over the last 30 years. Beyond credit performance, structural shifts in banking continues. The number of FDIC-insured banks has fallen to less than half its year 2000 level, driven by decades of consolidation and several major mergers in recent years. At the same time, digital adoption is accelerating. Online banking penetration has grown from just over 50% in 2019 to roughly 71% in 2025 and is projected to approach 80% by 2029. Over 74% of individuals 15 to 24 years old utilize mobile banking applications as their primary means of banking, compared to just 15% of those over 65. AI is now central to this transformation. Half of banks cite AI as their main strategic focus in 2026. Adoption of generative AI has accelerated rapidly, rising from just 10% of commercial banks having deployed solutions in 2023 to 47% in production by 2025. AI spending in commercial banking is forecasted to exceed $54 billion by 2028, up from $19 billion in 2024. For chief risk officers, AI is no longer experimental. It's embedded in underwriting, fraud detection, portfolio monitoring, and customer engagement strategy. The banking landscape is structurally transforming. Consolidation continues, digital adoption is accelerating, and AI investment is becoming central to competitive strategy. Institutions that modernize risk, data, and customer engagement capabilities will be best positioned to lead in this next phase of commercial banking. And there's a lot more on the changing banking industry in this week's report, so be sure to subscribe. If you found this update valuable, explore more at our Commercial Insights Hub and subscribe to our YouTube channel. And if today's insights sparked ideas about how Experian can drive your business forward, reach out. Last, remember to keep informed to stay ahead, and we'll catch you on the next one.